chapter 2. And we are actually going to consolidations. So in chapter 1, we just reviewed, our equity method, and we did everything that we did in chapter 1 was below 50%. There was no control, right? So in chapter 2, we're going to do consolidation on the date of acquisition. And the good news for you guys is that you're only going to do 100%. You do not have to worry about minority interest, because all we have to own is 51% to control 100%. Right? That's chapter 4. We're not doing that one this semester. Okay? So in chapter 2, it's consolidation on the date of acquisition. So let's talk a little bit. I'm going to kind of read to you a little bit of my outline. It says accounting standards are found in FASB Topic 805, Business Combinations, and 810, Consolidation. And what they require is that mushing together. When one corporation controls another corporation, you must report them as a group, a consolidated group, consolidated balance sheet, consolidated statement of income, consolidated statement of stockholders' equity, consolidated statement of cash flows. And so we're going to talk a little bit first about what is a business combination and what is control and that kind of thing. So the combination, even though legally these corporations are separate corporations legally, it's a substance over form issue. Remember in leases, when we had a capital lease, one of 4 things happened, and we said that the substance is the risk has been transferred. So one would treat it as a sold piece of equipment, and the other would be treated as a purchased piece of equipment rather than a rental. That's substance over form. In the same way, although legally these 2 corporations are separate, for accounting purpose, the substances, they are one. And that's our goal, is to mush them together. Okay? So it's the formation of a combination is the formation of a single economic entity. So for economic purposes, it's one entity, while for legal purposes, it's 2 entities. And it occurs whenever one company gains control, more than 50%. So there are several definitions you should know. The first is a statutory merger. That would be, you've got company A buys company B, and company B disappears. That's a merger. They gobbled them up. They swallowed them. Okay? Gone. And so B is gone. And it says the assets and liabilities could be acquired with the seller then dissolving itself. So if Casey Corporation wants to buy Jesse Corporation, okay? Casey Corporation can either buy Jesse Corporation stock or can buy all of her assets subject to all of her liabilities. In a statutory merger, all the assets are purchased, all the liabilities are assumed, and then all she's got is a big bunch of cash coming in. The assets go off, the liabilities go off. She's got cash and stockholders' equity, and she distributes all that cash to her stockholders, and they go out of business. And she puts the general ledger in her attic. B is gone. That's a merger. They've merged into A. But it could be that he buys her stock, 100% of her stock. Okay? Well, actually they said all of the capital stock can be acquired with the assets and liabilities then transferred to the buyer. So he buys the stock. now that he owns the stock, he just assumes the assets and liabilities, and it's also gone. So he could pay her stockholders. Rather than the corporation, he could pay her stockholders. And so they have money or your stock. It's a merger.
Could you buy all the stock theoretically and then still operate as two separate entities?
Yes. Which is what the 5 chapters that we've got talk about. Okay. Simulating a permanent merger. So really when we do consolidation accounting, we are simulating the permanent dissolution of one company, but maintaining the incorporation of both. There's still an A, there's still a B, but A owns all the stock of B. Okay? All right. So statutory consolidation is the assets or capital stock of 2 or more companies are transferred to a newly formed corporation. So we've got Hunter Corporation, that's C, is buying A and B. They're gone and it's just C. That's a statutory consolidation. So you had A, you had B, you formed a corporation that now gobbles both of them up. Boom. Boom. Right? You following? All right, and A and B are gone. And C is the one remaining. That's called a statutory consolidation. But the one we're going to spend time on, the acquisition by one company of a controlling interest, more than 50%, in the voting stock of a second corporation, and that's what you asked about, Hunter. Dissolution does not take place. He buys from however many stockholders he needs to get her more than 50%. He buys their stock. And he now owns 60% of Jesse Corporation. In chapters 2 and 3, he's buying 100%. Okay? In chapter 4, we introduce minority interest or non-controlling interest. What if he only buys 40%? And if you choose to go on to our graduate program, then in Accounting 6300, we start with that chapter. We assume that you know chapter 23. And we start with chapter 4. Non-controlling interest. So, some other definitions that I think are important. Tender offer is not when your sweetheart says, I'd love to take you to Paris. No, it's not that. A tender as in legal tender, cash. Okay? It's a proposal to buy some larger percentage of shareholder stock. So in case you wanted to buy the stock of Jesse, okay, he would go to the stockholders and make a tender offer to them. I'll give you this many dollars a share for your Jesse Corporation stock. That's a tender offer. A leveraged buyout is if he went and borrowed money to do it. Leveraged buyout. Leverage. Debt. So a takeover financed almost entirely with debt. So as long as Casey's got the ability to raise that much money with debt, he may not even have to come up with cash to go make his tender offer. A hostile takeover attempt is when he's doing that, he's threatening to gain control, usually with a leveraged buyout. This was what Pretty Woman, the movie Pretty Woman, that's what he did in Pretty Woman. He had a lot of hostile takeover attempts. And he would see that they had a small amount of debt to equity ratio. And so he knew that there was plenty of room in there to indebt the corporation more. He'd make a hostile takeover attempt with a tender offer, with a leveraged buyout. And then as soon as he had control of the company, he would declare a dividend, huge dividend for or he would go out and borrow as much money as he could, get the company heavily indebted, creating a lot of cash, then distribute all that cash as a dividend and leave the company to burn and die. This also is what T. Boone Pickens was famous for, and his picture is in our hallway twice. And it's legal. It's perhaps not ethical, but it's legal to be able to do that. If you've got the money for that tender offer, you can go and you can do that. So they were always looking for people with low debt to equity ratio, because they'd have room for them to incur more debt, creating some cash that they could distribute as a dividend and then just spit it out, throw it away. And that's what T. Boone Pickens was known for. Now he's really into the sustainability thing, but he's a billionaire, so, and that's how he became a billionaire. It was as our next definition, a raider. T. Boone Pickens was called a raider because he would do these hostile takeover attempts with a leveraged buyout. Many of them. Sometimes a white knight comes on the scene and says, no, we know what T. Boone Pickens is going to do to you. And so they will go to the stockholders and say, instead of selling out, I'll buy your stock, Mr. White Knight, on his, knight in shining armor, white horse and everything. You with me? And he makes a different tender offer. Maybe it's not as good, but ethically he appeals to the sense of the ethical values of the stockholders, and hopefully a controlling number of them go with the white knight. And then they don't die. Sometimes instead of that, and if you watch that movie Pretty Woman, there is one episode, one little series in there where a company offers to give the raider, like, I don't know, $1 million or $2 million just to go away. That's greenmail. That's your next definition. We'll pay you this much money if you'll just not make the tender offer to our stockholders. Greenmail. It's like blackmail, but we're going to give you money to go away. What does help a company not to be ripe for a hostile takeover attempt is two things. A solid debt to equity ratio, where you've already got, your capital balance already has a lot of debt. Okay, too low makes you ripe. But if there's a reason for you to keep your debt to equity ratio low, then you at least have golden parachutes. And these are clauses in all the O contracts, the CFO, the COO, the CEO, the OOOOOO, all those people. That if, and I don't know how they word it, because they do it, in legal language, but if a hostile takeover attempt should happen, then each of the O's get $1 million bonus. That is an example of a golden parachute. Or if there is a leveraged buyout or whatever. So these are clauses in those officers' contracts, and that will make T. Boone Pickens go to somebody else. So a healthy debt to equity ratio keeps you from being ripe for a hostile takeover, and golden parachutes protect you somewhat from a hostile takeover. Make sense? Because he knows that as soon as that happens, some of the cash has got to go to those O's for their bonus thing in their clause. Sometimes the company can reorganize, and we do talk about that in Accounting 6300, reorganization plan. But sometimes there's a poison pill, which is an agreement with the corporation that's being threatened by the raider, and their stockholders to allow them to buy cheap stock if and only if a hostile takeover attempt comes across our path. It's a poison pill, which is another way to divert T. Boone Pickens or another raider from coming and getting you. Okay? So those are all, so the next time you see Pretty Woman on TV, they just run reruns all the time of that movie because it's so old, right? Just watch the first little part, like the first 15 minutes, and you'll see a corporate raider, you'll see these hostile takeover attempts and greenmail and all that. Reading in between the lines if she's a prostitute and whatever, and all that goes with the movie, because it's a great movie. It's a great chick flick movie. It earns guys really good points. How about if we stay home and pop some popcorn and watch Pretty Woman? Oh, okay. But then you guys can say, and I'm going to really watch for the corporate raiders and the green talks about then is, what do we do with financial statements? And so our goal is a single set, it's a consolidated balance sheet, a consolidated statement of income, a consolidated statement of cash flows, when we have the simulated permanent merger or consolidation. We're simulating as though Casey bought the assets and liabilities, but what he bought was the stock. So this corporation's still operating, that corporation's still operating, but you control this corporation. So far, so good. We're going to simulate that. We start with the adjusted trial balances of both. So you don't do correcting entries, you don't do adjusting entries, that's done. We've got their individual financial statements done. And that's the beginning of our consolidation, which is a simulated permanent merger or permanent consolidation. Okay? So far, so good. You see where we're headed. And it's done with a worksheet, and there are consolidation entries. Okay, I need my board back, so I'm taking this stuff off. So as we create, by the way, Exhibit 2-2 is really good. Should know that. What is to be consolidated, bottom of 46, you should know that. If there's dissolution, top of 47, I'm going to read that. When does consolidation take place? If dissolution takes place, it's a permanent consolidation. And now Casey Corporation has not only their cash, but also Jesse cash. Not only their inventory, but also, so Jesse Corporation's got more cash, more inventory, more receivables, more liabilities, more, okay? Okay? But with the same stockholders' equity. Okay? But the second bullet on 47, if separate incorporation is maintained, he buys the stock instead of the assets and liabilities. The consolidation process is carried out at regular intervals. How regular? Every time we want a balance sheet, income statement, every time we want a set of financials, at least once a year. And how are the accounting records affected? Well, if it's dissolution, his assets increased, his liabilities increased, hers went to zero, and she files away her general ledger in the attic. But if we have separate incorporation, each company continues to retain its own records. She's still debiting and crediting, she's still paying bills, okay? But he controls it. And what we do is we use a worksheet. And on that worksheet, we are going to have three types of entries. So you'll have the first column of the worksheet is the parent company, which is the one that bought. The parent company's adjusted trial balance. The second column is the subsidiary company's adjusted trial balance. And then you have two columns for consolidation entries. Consolidation entries do one of three things to different accounts. Number one, they can eliminate certain accounts. Because on Casey Corporation's financial statements, he's got an account called Investment in Jesse Corporation. That's why we did chapter 1. Okay? The same thing we were doing here, and he's accounting for it on the equity method like this. But if we're going to mush the two together, then we don't need that account. So we're going to eliminate certain accounts. We're also, because Jesse Corporation no longer has stockholders, when we report this consolidated company, the consolidated balance sheet, the only stockholders are Jesse Corporation stockholders. So we need to eliminate Jesse Corporation's APIC and common stock and retained earnings. Those have to be eliminated. And the only stockholders' equity we have left is Jesse Corporation, because that's who we're reporting to. Our purpose of reporting is that Jesse Corporation, all of Jesse Corporation's personal, their own assets and liabilities, but also the ones they control of Jesse Corporation. So Casey Corporation and Jesse Corporation, right? All right, so we can eliminate. Sometimes we adjust. And because Casey Corporation is going to buy, just like, and we're going to do DDESs. The good news on the DDES is chapters 2 and 3, we're buying 100%. So no longer do you have to multiply the book value times 40%. It's just the book value. And you don't have to multiply the trademark by 40%. It's just the amount of under or overvaluation. So so it makes that a little bit simpler. But the fact is, when Casey bought Jesse's stock, on that date, the trademark is undervalued by $50,000. We want the consolidated trademark to include that $50,000 because it was sold by Jesse to Casey. Okay, so we want the trademarks to be Casey adjusted balance plus Jesse adjusted balance, which is without the undervaluation, plus $50,000. So in this way, we're going to adjust for that $50,000. We're going to add or subtract the under overvaluations. And we have to also do the amortization of that each year. So we'll adjust $50,000. Well, it's $2,500 in 1 year, so after 1 year, it'd be $47,500. And the next year it'd be $45,000. And the next year it'd be $42,500. Are you following? So we need to adjust the balances we've got on the books for those over or under valuations from the DDES. There are other things that are adjusted, but that's the main adjustments is from the DDES. And then the third thing that we can do is create. We can create new accounts. The most common to be created is goodwill from the DDES. It's not on the books, but because Casey bought Jesse, you see, that if the DDES has goodwill, or if there was a patent that wasn't recorded, then we have to put that on. It's 0 plus 0 for adjusted balances plus the amount that is created. So we create some accounts, we adjust some accounts, we eliminate some accounts. In each of the consolidation entries, which are only done on a worksheet, they're just done on an Excel worksheet. They're not posted anywhere. You remember our accounting cycle, we journalize, then we post, then we pull the trial balance. Well, these are journalized, but they're never posted. They will not be posted to Jesse Corporation. To Casey Corporation, they will not be posted to Jesse Corporation. Okay? They're only on the consolidation worksheet. Because oftentimes, one is debiting Casey Corporation or Jesse, and the other is on the other side. When we eliminate investment in Jesse Corporation off of Casey's books, we're eliminating it against Jesse's stockholders' equity accounts. Basically. Okay? So let's read page 47. The method that is used for consolidation right now, for any new consolidations, is called the acquisition method. There are other methods, and the reason they're in your book is because old consolidations could be on the other methods. That's why they give you the other methods, because you could go to work for someone that did a consolidation back in 2007, and they could have been using one of the other methods. But for all new acquisitions in the United States, in 2014, we use the acquisition method. So it says, regardless, I'm reading page 47, regardless of whether the acquired firm maintains its separate incorporation or dissolution takes place, current standards require the acquisition method to account for business combinations, whether it's permanent, where Casey Corp bought assets and liabilities, and it's a permanent merger, or Hunter Corporation bought both of these, and it's a permanent consolidation, or whether we are simulating either one of those, okay, where they bought the stock. Applying the acquisition method involves recognizing and measuring three things. The consideration transferred, which in chapter 1 we called the purchase price, the top of the DDES, We're now going to call it the acquisition price or the consideration transferred. Consideration paid, consideration transferred, acquisition price, which is the top line of our DDES. Secondly, the separately identified assets acquired and liabilities assumed. So we still have to do a DDES and determine the over and under valuations. And then thirdly, the bottom of our DDES, the goodwill. Or if it's negative goodwill, that's a bargain, and the bargain purchase. So far, so good. And it says, and this is important, right under the 3 bullets, fair value is the measurement attribute used to recognize these and other aspects of a business combination. So, before examining specific applications of the acquisition method, there is a discussion here about what is fair value. What is fair value? And you just need to understand pages 47, 48, 49 solid. Okay? Which makes the doing it easier. If you understand the why, the what is a whole lot easier. So far, so good. Any questions so far? All right, on page 49, and I will let you please read that before next time. Okay? Today is Thursday, you've got until Tuesday. So read those pages, make sure you understand market approach, income approach, cost approach, all of those things. And they'll tell you what we're using. Okay, so what they're going to use here, the data is on page 50, exhibit 2.3, big net, of course that's the parent, that's the big, and small port, that's the small, the subsidiary, right? Now we don't care about big net's fair market values because big net is not being sold. What's being sold is small. So the only one whose fair values are relevant are small. Because when do we get to record at fair value? When it's sold or when it's purchased. Well, the only one being purchased is small port. So big net, we don't need fair market value. So far, so good. So what they gave you here is the under and over valuations for small port, as well as their book values. Because remember, there's 2 reasons that big net is going to pay more or less. Number 1, under and over valuations of assets and liabilities, and number 2, goodwill. So far, so good. So they did for you, first of all, they said, what if they pay fair market value? So bottom of page 50, what if big net pays fair market value, which would be the fair value of the assets, $2,550,000, minus the owner's equity, $600,000, okay, is $2 million. No, sorry, that was net assets. What if they pay the fair market value of $2,550,000? And it's a permanent dissolution. This is the only time we're going to talk about permanent dissolution. The rest of the time we're going to simulate it. That's what the whole chapters are about. Thank you, 5 minutes. Okay, so they pay $2,550,000. Whether they pay it with cash or with distributing their stock, in this case they did it with a combination of the 2. So the cash paid, down payment, was $550,000. I'm on the journal entry, page 51. So they credited cash, they credited par per share times number of shares. They distributed to them 20,000 unissued shares of $10 par. Par per share, $10, times number of shares, 20,000 is 200,000, and APIC for the difference. They were worth, currently selling for $100 a share. So 100 minus 10 is $90 APIC times 20,000 shares is 1.8, right? I mean, that's just basic issuing shares. So there's the last 3 lines on page 51 in the credit side. That's your consideration paid or your consideration transferred. But in this case, it's a permanent consolidation. They bought the assets subject to the liabilities. And And so Casey would just record all the assets, record the liabilities, and Jesse Corporation would get that money in that stock, take all their assets and liabilities off the books. Then all they've got left is stockholders' equity and cash and stock. They distribute that to the shareholders. No debits, no credits left. Okay, trial balance is everything's zero. She puts it in the attic. Okay. What if Casey Corp paid more? What if Big Net paid more? So in this case, $3 million instead of $2,550,000, middle of 51. Well, in that case, the difference between the fair market value, $2,550,000, and the consideration transferred, $3 million, is goodwill. We do a DDES, and you see the goodwill on page 52. So they changed their cash from $550,000 to $1 million, and goodwill had to go up. So far, so good. What if they didn't? What if Casey Corp, or in this case Big Net, what if Big Net bought it for less than $2,550,000? Then they got a bargain. That's page 53. In this case, the bargain was $550,000 because they bought it for $2 million. Big Net is still recording everything at their fair market value. All the assets, all the liabilities at fair market value. Recording what they spent, but in this case, they got a bargain, and it's a gain on a bargain purchase. Pretty easy, right? Also, what about different expenses? Because when one corporation buys either the assets subject to liabilities or the stock of another, there are things that they pay. Professional services expense, that's your lawyers and your accountants, is an expense. Bottom of page 54. And it's summarized, the kinds of expenses are summarized on exhibit 2.5, page 55. So direct costs are expenses incurred. Indirect costs are also expenses incurred, but issuing the securities cost, that affects APIC. Typically APIC, unless there is no APIC, because you can only minus APIC if you have it, right? We've learned this in treasury stock. So if you got APIC, if Casey Corp has some indirect costs for issuing the shares of stock, and Casey Corp has Casey Corp APIC, they can debit APIC. If there's any, he's got to get retained earnings. Same way we did with treasury stock. Okay? In this case, there was. If you'll notice, you go back to that page 50, under Big Net, it says their APIC was $40,000. So they had $40,000. They could go up to $40,000 with a debit to APIC and a credit to cash. Anything above that would have to be retained earnings. So far, so good. That's as much as we're going to talk about permanent dissolution, and we're going to do the next part of the chapter next time, where we're going to simulate a permanent consolidation or merger. Thank you.